Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, and this is really the scenario development we're going to work off and go through at least a couple of these. I don't know if we'll get to all of those given the time we have, but we're definitely going to get to the first two, the risk bid and the muddle through, and I'll describe the growth surprise briefly here in case we don't get to it. The risk bid scenario is what I've talked about earlier. This dollar smile scenario was created by Stephen Yen of Morgan Stanley. He was a currency analyst for Morgan Stanley and was really excellent. I've learned a lot over the years reading his stuff. He's since left Morgan Stanley and moved on to a hedge fund just recently, but really a brilliant person and a really great insight on how the macro economy impacts various currencies. And he came up with this framework back in 2006, I believe it was, a little bit later, and it still applies today. On the left side of this smile, so to speak, you get the risk bid, meaning the dollar rises on a risk bid. On the right side of the smile, right over here, the dollar rises based on the growth surprise, meaning the U.S. economy is going to grow faster than its competitors. And our scenario on the growth surprise is that the U.S. economy could potentially come out of this morass much faster than the European economies. And if that's the case, we would expect and see the expectation in the market for the Fed to raise interest rates sooner and faster than both the ECB and the Bank of England. Again, it's an outside chance and it's, of it happening. But as the numbers come through and you look deeper and deeper inside both the UK and the Eurozone economy, this idea of a relative growth surprise of the U.S. outperforming both those areas, I think is the probability is there that it could happen. Again, hard to see it now, but just wanted to make that clear and be open to that. I wouldn't think that this idea of a growth surprise would suggest that the U.S. would be growing faster than the emerging markets or faster than the commodity currencies such as the Canadian and Australian dollar, which would continue to do well. I would see this as the U.S. supporting the growth of the emerging markets, China still leading the way, but the Eurozone economy pulling up the rear. So it's really a scenario in which the U.S. dollar does better against the Euro, UK, and Swiss franc, the key European currencies, but on a relative basis is probably in the same ballpark with the commodity currencies as China and the emerging markets in the U.S. move up together. Now, the other scenario here, and there's really two of them inside here, is this idea that the U.S. dollar falls on what's called a muddle-through policy. This idea, as I said earlier, in which the U.S. government wants to put us back into the implicit weak dollar policy and try and use the dollar to lubricate global markets and get us out of here in some type of managed currency, manage the U.S. dollar lower. What's interesting is in this past bear market cycle, let me go back here, you can see how there was really a relatively gradual decline in the U.S. dollar during this implicit weak dollar policy. That's really this scenario of muddle through. Get back into the area where you can manage the currency lower, make your exports a little more competitive relative to your competition, lubricate global markets, that type of thing. That's one scenario here. The other scenario on the bottom of the dollar smile that I don't have listed here, which really is coming into play, is really the dollar crisis scenario. And again, this is a debt-based scenario, looking at all the money the U.S. government keeps throwing in debt to try and create stimulus, and they're really eating away at the private capital of the U.S., eating away at the seed corn of the U.S., and hurting the entrepreneur. That's the dollar disaster scenario, and it would be bad, very bad for the U.S. consumer, and in fact, very, very bad for the global economy in general. It kind of comes, a spike down dollar crisis and really brings that idea of the U.S. losing its reserve currency status into play. So those are the, basically four, I guess, scenarios based on this dollar smile, and let's get started with it. The major real driver right here that we see in the market which can lead to a risk bid scenario, or ultimately in the long run can be beneficial to the global economy, is the idea of global rebalancing. And we're seeing it in a very, very big way. We're seeing the overconsumption in the West start to balance from the overproduction in the East. And if you think about really the players here, we're talking about several countries, but in general, the poster children for this, China is the overproduction in the East. The United States and the U.S. consumer really represents the overconsumption in the West. In the midst of that implicit weak dollar policy, when the U.S. was in that 7-year bear market, at the bottom of that, from a savings rate standpoint, the U.S. consumer was actually negative 2% of GDP in terms of savings. Very, very bad long-term in terms of seed capital for your, or at least a pool of capital for your country. But again, the U.S. government wasn't real concerned about that because, again, housing prices were going up, stock prices were going up. So the U.S. consumer thought he had all this wealth so he could just consume and not save. Needless to say, as we said, the credit crunch, which we think is a sea change in the global economy, a structural sea change, launched the idea of now all of a sudden, hey, my house just tanked, my job's in trouble, stocks have bounced, but how much, from a relative standpoint, I'm still down a bunch. I need to save. I need to repair the balance sheet. U.S. consumers lost up to 15 to 16 trillion in wealth estimated over the last couple of years. That means they need to start to save, and we're seeing savings rates soar up to 6 to 7% now of GDP from a negative 2% that quickly because of this credit crunch and this global rebalancing that's taking place. So in effect, all these current account deficit nations, again, the U.S. as an example, the current account deficits are starting to decline, and all these current account surplus nations, their surpluses are starting to decline. In fact, the U.S. current account deficit has improved 50% in the last 6 months. We think the U.S. current account deficit will go positive before we get out of this move here. That's our main scenario because of the fact we think the U.S. consumer is going to save measured in years, not months, and because of the fact we think this is a cyclical change in the global economy and not a secular change, a multi-year change, and not the normal cycle, the normal business cycle type of change, precisely because global rebalancing is taking place. We think a lot of pain is going to be pushed on to those export nations in the world because global macro money flows have to balance. So if the U.S. consumer, who was negative 2% in a savings rate, borrowing to consume, all of a sudden turns around and pushes a savings rate up to 10%. 10% of GDP. 10% of the U.S. GDP is about $1.4 trillion. That means the U.S. consumer imports about $1.4 trillion less than he did before. Obviously, there's some other spending in there. But it's a massive hit to the export world, meaning those that are geared to the export model, i.e. China. If China's exports decline, $1 trillion a year in an economy that's a $4 trillion economy that's geared to exports for growth, they start taking a lot of pain domestically, and they're starting to do that. And that's why they've pumped up this stimulus package. But there's other problems there, and I'll get to that. But the reality is we could see a multi-year change in gut-wrenching structural change to those export models out there. And again, Asia, China, Germany. Germany is being hit very, very hard. Germany is a major exporter in the world, needless to say, the world's largest exporter, and they're getting hit very, very hard because of this global rebalancing in Europe. And if you don't know, Germany is the key driver of European growth. They are the engine of growth out there. So this is an important impact here, this global rebalancing. If it is a secular thing and the U.S. doesn't start buying, we could see this pain continue in a big way, and we happen to think it will.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.